So we want to take a look at Chapter 15. Chapter 15, like Chapter 14, is about raising capital, but this time what we are studying is how to raise debt capital. The process is not as complicated as raising equity capital, partly because debt is less risky, partly because it is pretty straightforward. It is laid out in contractual terms, what can be done and how the money is going to be used and all that stuff. So it presents less complexity and somewhat simpler to process in terms of how debt financing is done. There are two ways to do debt financing. One is to use the private debt market. In the private debt market, essentially you're going to banks and getting a loan. It tells you the term of the loan. If it is a term loan, how long is the loan for, how much you would pay interest. It could be a line of credit. It could be an asset-backed loan, non-asset-backed loan, and so on and so forth. But what we're mostly interested in is looking at public debt. And the process is very similar, like a stock equity financing. You use a prospectus, but in this prospectus now you have something called an indenture. An indenture is the formal contract between the bond issuer and the trust company which represents the bondholder's interest. And it is this indenture that lays out essentially through the covenant what kind of requirements are there in terms of things that can or cannot be done with the money that has been raised. The coupon bond is always issued at a discount. And if the coupon bond is issued at a discount, it is called an original issue discount bond or an OID bond. But a coupon bond can also be issued at a par, and it is of course not a discount bond, depending upon how the bond is issued. And we know the relationship between a discount bond, a premium bond, and a par bond. If coupon rate is greater than the required rate of return, then that would imply a premium bond. If coupon rate is less than the required rate of return, then that would imply a discount bond. And if coupon rate is equal to the required rate of return, then that would imply a par value bond. So here is the front cover of the MOU that kind of lays out the public issue. It tells us how much money we are raising, at what coupon rate, and when will this be due. If they are in different tranches, this partly it is designated in euro, so it also has an international dimension to it. Who are the syndicate of issuers that are working to help the company bring this issue? These are essentially the book managers that will buy the bond from the company and then sell the bond to the public. Public debt can be unsecured, meaning there is no exact asset backing the debt, or it can be secured. Typically, it is called a mortgage bond, where it specifies that assets of the company can be sold as a claim against the debt if the debt terms are not fully met, i.e. if interest payments and principal payments are not met. So a mortgage bond is secured with real property, and an asset-backed bond is secured with any asset. It doesn't have to be property. It could be, for example, copyrights. It could be other kinds of things that are not viewed as tangible assets. In unsecured bonds, you have notes that have maturity of 10 years or less, or debentures that have a maturity of 10 years or more. The bondholder always has seniority. In the event of a default, they can claim assets. A subordinated debenture has a lower priority claim, but nonetheless does have a priority claim over other outstanding debts. Typically, bonds are sold in tranches because they are sold with different classes that specify different types of either asset backing or different types of coupon and so on and so forth, but they're still considered a single bond issue. For example, over here, in the example that we were looking at, one tranche is a dollar-denominated note, a second tranche is a euro-denominated note, and a third tranche is a senior subordinated dollar-denominated note. So $1.8 billion here, 225 million euros, $600 million, their respective maturity dates, perhaps the most important number for us, their coupons, they're issued at par. That means this number, this coupon rate of C% is equal, for this to be equal to par, that means C is equal to R. That means the yield, as you can see over here, yield and coupon, they're exactly the same as it would be. And then their bond ratings from the different agencies. Public debt can also be in the form of international bonds. Domestic bonds, of course, are that are issued by the local entity and traded in the local market, but are purchased by foreigners. So they can be denominated in local currency. Foreign bonds are issued by foreign companies in a local market and are intended for local investors. So they're denominated in local currencies also. So Yankee bonds are often viewed as foreign bonds that are issued in the United States. So a bond for a British company being sold in the United States would be viewed as a Yankee bond. Euro bonds are very interesting. They are international bonds that are not denominated in the local currency of the country in which they're issued. So a bond issue for a US company could be issued in Belgium denominated in euro, in the currency euro, and they would be considered a euro bond. Or it could be issued in Japan, designated in yen, and it would still be considered a euro bond. So don't focus on the word euro to mean something that is geographical. It simply means if a bond satisfies this criteria, then they would be considered a euro bond. Global bonds combine the features of domestic, foreign, and euro bonds and are offered for sale in several different markets simultaneously. So you can see a total issue, a new debt issue for a particular company, in this case Hertz, can be several types. So because it is difficult to raise money through the debt market, much more less risky but much more difficult to have access to the total amount of capital that they're looking for, over here 11 billion, so they break it up into different possibilities so that they can fully raise the amount of debt that they're looking for. So different tranches over here, tranche 1, tranche 2, tranche 3, and then some of it through private debt. Bonds also have what we call covenants. These are essentially restrictive clauses in the bond contract that limit the company from taking actions that would undercut its ability to repay the bonds. That means it is limiting the company that is using the bonds to raise capital. It is limiting that company's ability on what it can do with the capital that they're raising. And this is necessary because bondholders, unlike stockholders, do not have any say in the operation of the firm. The stockholder, through the board of directors, can have a say in the operation of the firm. The bondholders has no legal recourse over the firm once they give the money to the firm. So to prevent the firm from taking bondholders' money and taking on excessive risk that reduces the firm's ability to repay the interest and or the principal, then bondholders are essentially putting in these covenants so that they are assured of their repayment. So the more covenants that the firm puts in, they can reduce the cost of borrowing. That's one advantage. However, that comes at a loss of flexibility. So the firm has to balance between the reduction in the cost of borrowings, because by giving bondholders more certainty, less risk for their capital, they can reduce the cost of borrowing, but on the other hand, they will also suffer loss of flexibility with the money that they are receiving from the bondholders. So what are typical bond covenants? Bond covenants can put restriction on what type of new debt the firm takes on. How do the firm pays dividend? For example, payouts can be made only from earnings generated after the bond issue. Payouts can be made only if earnings exceed a certain threshold. It restricts mergers and acquisition. It restricts how assets can be disposed. For example, the maximum amount of assets that can be sold, or the minimum amount of assets that the firm has that must be maintained. These are all provisions that provide security to the bondholder that their capital is not at risk, or is at minimum a risk as possible. In addition, they put in accounting measures. For example, what is the minimum threshold for retained earnings, for working capital, for some of the leverage ratios that we had learned about earlier, such as current asset, debt to equity ratio, quick ratio, and so on and so forth. In addition, bonds may have what we call a call provision, which says that the issuing firm can recall the bond before maturity, but they have to provide a call date, they have to provide a call price. For example, over here, it says for tranche 1, up to 35% of the outstanding debt can be recalled at 108.875% in the first 3 years. After the first 3 years, they can be recalled at this price, at this price, at this date, and this date, and from after that at par value. Similarly for tranche 2 and tranche 3. So what does the call feature do to the bond? It certainly makes the investors pay less, because now for the investment that they're making, there is no assurance that they can carry the investment all the way through the final term of the bond. The bond may be recalled before we get to the final date. But this helps because a firm, by issuing a callable bond instead of a non-callable bond, will thus have to either pay a higher coupon rate or accept lower proceeds. But why would they do this? One of the reasons they do this is because they can retire the debt early. They can retire the debt early. And this helps in reducing the debt obligation over the life of the bond, because they can now get out of the debt. Essentially, they will have a high debt ratio now, but 3-4 years down the road, they can reduce the debt ratio. That's number one. Number two, if the bond is issued during a period of high interest rate, that means coupon rate, since coupon rate is matched to the required rate of return, that means bonds issued during high interest rate periods would have high coupon rates. That means the firm is now obligated to make large interest payments down the road. To avoid that possibility of being obligated to make high interest payments down the road, one of the ways they can get out of that is to recall the bond, and then reissue it at a lower interest rate. If interest rates drops over either that first 3-year period or the 4th year, 5th year period, they can reissue the bond at a lower price, at a lower coupon. So that saves the company interest obligations going forward. So here is an example. The company has issued a callable bond at par. So we assume par value as $100, 8% coupon. So coupon is $8. But the bond can be recalled anytime in 1 year at par. That means at 100. its current price is 103, that's B0, and its yield to maturity is 7.26. What is the bond's yield to call? So the bond is a 5-year bond, but after year 1, the bond can be called. So its original cash flow would be $8 each year, and in the final year, 100, which is the par value or the face value plus the coupon of $8. So if I did present value of 103, future value 108, payment of 8, N of 5, and I computed IY, I would get essentially a YTM of 7.26%. Okay. But what is its yield to call? If the bond can be recalled a year from today at $100, that means your cash flow a year from now would be the call price. This is the call price, plus $8, which is the coupon. That means your future value a year from now is $108. So future value is 108. Present value is 103. N is 1. There's no other payment. In between here and here, there's no other payment. So I'm going to compute IY, which is essentially going to be my yield to call. So yield to call is going to be 4.85. Actually, I would not write it this way. I would write it over here like this. So that's 4.85. That's my yield to call. So yield to maturity was 7.26. But because of this call feature, there is a possibility that you only get back 4.85% as a return on your investment. This is what makes a callable bond. The firm will then have to either provide higher coupon or lower the price in order to entice people to invest in a callable bond. So your YTM is higher than YTC because for a YTM you are receiving all your coupon payments over the 5 years. But if you have a callable bond, now you are getting your money back after year 1, but you are not fully invested for the remaining 4 years. So this lowers your total return. So you can practice a similar problem like this for yield to call. Okay, so finally, a repayment. If a bond has, bonds may have, in addition, bonds may have sinking fund provision. So a company essentially, because the bond will have to be retired after 3-year, 4-year, 5-year, 10 years, whenever. So when the retirement date comes, there's a large payment that the firm has to make. To avoid that large payment, one-time large payment, what the firm does, it takes a portion of that large payment and essentially saves it into a fund. So when that large payment date arrives, they already have a fund waiting to pay that out. In addition, bonds may have what we call a convertible feature that converts the bonds into common stock at a later date. So consider a convertible bond with $1,000 face value and a conversion ratio of 20. So if you converted the bond into stock on its maturity, you would receive 20 shares. That's what this conversion ratio of 20. If you did not, then you would receive the $1,000. So by converting the bond, you have essentially paid into a stock, essentially paid $1,000 for the 20 shares. That means you are implying that the conversion price is $50, $1,000 for the par value divided by the conversion ratio of 20. So if the stock in the open market is trading at more than 50, then you would convert it into the common stock, because now you're essentially acquiring a stock at $50 when in the market it is trading at more than 50. But if the stock is trading below 50, then you would be better off accepting the final payment of the par value for the bond. Okay, and that would, don't worry about this, this part of it. That's the extent to which I want you to understand what a convertible bond does. Essentially, it converts bonds into shares at a future date. And the important part to know is, how do I make the decision? And the decision that I make is based on two things: the conversion ratio and the market price of the stock. If the market price of the stock is above 50, then I exercise my right to convert. If it is below 50, I do not exercise my right to convert. So that completes chapter 15.